Peter Tchir joins us, head of macro strategy at Academy Securities. Peter, welcome back. Great to have you on the Schwab Network as always. Happy New Year.
Happy New Year to you as well.
All right, so what's your framework going into this year as we just put in highs for the S&P 500? Do you ride that wave or try and fight it?
I'm fighting that right now. I've been fighting it off and on probably since late December. We kind of traded off, so the all-time highs aren't as exciting. If you kind of caught it, you're back to where we are. I just think that rates are going higher. And part of it makes sense last week that we started pricing out a recession. I think we are premature to price out a recession. So that's why stocks did well, even with rates higher. My bigger concern is that a lot of the issues that caused the 10-year to go to 5% back in the fall have not been addressed. The deficit's still real. All these problems are still real, whether Powell's pivoting or not, that's not going away. So I think we're going to see yields go higher, curves uninvert, and I think that's going to put some pressure on the stock market in the coming weeks.
Okay, so come back to the point about why stocks so far have shrugged off the higher rates in the last, basically year to date. Why do you think that's happened?
So when we were starting to price in 6 rate cuts on the Fed, and now we're down to about 5, and I think it got as high as 7, it was partly because people were looking at the economy and saying recession's coming. So as rates have been inching up, people are saying, well, recession's not coming. We've had enough good data. It looks like soft landing, no landing's kind of winning. So that, to me, is why we were able to, rally through this. That's why I think the next leg of yields higher, if it's independent of market data and really comes back to pricing in risk premium and term premium and fears about the U.S., willingness or ability to spend and pay its debts, then I think that's when stocks can't do well. And next week will be very telling because one thing we've learned now is ignore everything everyone says except what Powell says at the press conference.
Yeah, that's true. Seems like the market generally has ignored most of the commentary because we're still at 47% for March. So to your point, we've priced it down, but market still is basically giving a coin flip when all the Fed speakers have alluded to it basically being zero, that we're not going to go in March. So I guess the market still thinks it's up to Powell next week.
Yeah, and I think if you go back to the last meeting, I think it was just 2 weeks before, Powell had said cuts were not on the table, and said it might be more hikes. Then he came out of the meeting, and all of a sudden he's talking about cuts. So you couldn't even listen to what he said ahead of the meeting. So I think that's left the market very, confused. And I think everyone downplays. Yes, we get the message that they want to be hawkish, but I think Powell is going to have to deliver on that hawkishness for the market to really get fearful.
All right. So in lieu of like any blow up bond auctions, what then kind of level would start to bring a more fearful tone in markets when it comes to rates? Do we need to get back into that uptrend we were for like the last couple of years? Because to me, that line is at like 4.4-ish. That's kind of far away from here. I guess not that far.
On the way the treasuries move, it's like, when I was calling for 430 and it was 380, it seemed like a long time ago and it wasn't. So I think we can get to 450 fairly quickly. Okay. And I think that's where even through 440, you start breaking it. And again, it's really nice that we're at these all-time highs, but I think you just mentioned it's been very, the breadth has been small again, right? The Russell 2000 struggling. And what surprises me of all the things is ARK continues to struggle, right? So if this was really a land grab, hey, we need to buy equities, we need to put it into equities, and it's things like ARK should be outperforming, they're not. So it feels like the market's been a little bit lazy and almost sloppy and just going back, hey, this worked for much of last year. We just buy the big tech, we buy the big names and let that run. And that trade's playing through again. And I think it's kind of lazy and sloppy, and I think we're going to see the Russell 2000 and ARK are actually leading the way this time, and their trajectory has not been positive.
I'm glad you bring that up because I've actually argued that it's kind of a healthy thing in the market to not see like the super unprofitable, risky businesses going parabolic like in COVID bubble or dot-com bubble. I mean, does that not insulate us a little bit, their underperformance from like rapid crash-style sell-offs?
I think it would, except we've never really been able to get off the ground with those, right? Even last year, they kind of performed more or less in line with the NASDAQ 100. A lot of these are at very cheap levels. They've been at these cheap levels. It feels like they just can't get any buzz. So I'm not looking for any sort of, accelerated growth on these or, huge returns, but I would expect them to outperform the NASDAQ 100 by at least a little bit. And that tells me either people are being very selective, which would be good, or we've just been a little bit sloppy and have gone back to the trades that worked last year. And that to me is the inkling I get, that it's a little bit more sloppiness and going back to the trades that worked last year. And what worked last year really works this year. And the other thing that's coming up more and more in my thought process is what's going on with China. because I think China is very interesting. I actually like it for a trade on the stock side, but there are issues there. And if China doesn't do well, I'm not sure how well the US stock market can do.
Hey, China's stocks have been doing absolutely terrible while we're making highs. What makes you think that there's dependency there?
Well, one, I think we finally had maybe hopefully a capitulation trade yesterday, and we're seeing a rebound. We're seeing Chinese government actually start coming back. But at some point, right, the global economy still is tied to China to some degree, far less than it used to be. But for us to say everything's going to be great while China's struggling, I think that's unrealistic. I think China's response to this is going to be either trying to sell their own goods and brands elsewhere. They're not going to take this line down. And so I think that's where we're being maybe a little bit cavalier here.
So the trade for China, talk me through it. I mean, think they're going to make some effort that will get their stocks back on track, like a long trade, or you think it's going to get worse?
I think in the near term, they're going to put some stimulus. There was talk of that last night. I think the things that we're hearing going on in China, there were a lot of structured notes sold to retail that effectively caused this kind of gamma trade that forces down. I think the government's well aware of that. If you look at the Chinese citizen, right, for many of the middle income people, their greatest wealth was housing, which is a mess. Now you've got their stock market, which is in a mess. And Xi is somewhat sensitive that, yes, he's like a dictator. Yes, they control their population very well. But the reality is we saw when we went from COVID zero to all of a sudden, oh, COVID's fine in China, it was because of a series of protests. So look for them, I think, to address this unsettling nature of what's going on with the middle class. And I think that triggers stimulus there. And I think that stimulus, given that we've watched our way down, I can't find a single person who likes Chinese stocks this year. And last year at this time, everyone liked Chinese stocks. I hated them. I do not like investing in China long term. Don't get me wrong. I think it's going to be very difficult for companies to get their money out. You as an investor might not be treated well. But for a month to 2 month trade, I think now buy some FXI, buy some KWEB, let it ride.
All right. So taking a stab at beating down China trades, fighting the tech-driven market rally here, looking for yields to pick up. That's like 3 out of 4 of the major asset classes. What about Bitcoin, Peter? Give me a crypto thought after the ETF fade.
And just one thing I do want to add on the S&P 500,
Sure.
the futures were at 47.62, which was a strong support level, a good time to take some off. So we're at all-time highs, but just last Tuesday or Wednesday, it looked pretty weak and sloppy. So I'm not that concerned. On Bitcoin, I think we continue to sell off. One thing that frustrated me through this whole process was I listened to a lot of the, cheerleaders, whatever you want to call them.
That was your first
talking
mistake,
about
Peter.
the ET. Pardon?
That was your first mistake.
Well, sorry, I was listening to him. I always try and listen to what the other side's saying. And they were so gung-ho on these ETFs, but they weren't explaining ETF mechanics very well. So it doesn't surprise me at all that the launch has been somewhat disappointing in terms of new flows. And people kind of got way ahead of themselves. And it was just very strange. The influencers were pumping. It didn't seem realistic. My fear was that we would get a disappointment, and then it would turn out a lot of people bought Bitcoin ahead of the ETF ramp, or alleged ETF ramp, and they did it on leverage. And I think that's what's unwinding right now. So I think we could break down to 32,000 in the coming days or weeks, because I think you're going to see ongoing pressure with outflows out of GBTC. I think that's going to make people nervous. We are not getting this new set of buyers coming in. You're not seeing huge net demand. Yesterday, I think there were actually net outflows, including from the new ones. So I think that pulls that back. And I wouldn't be so concerned if the hype hadn't been so high. Some of it based on a lack of understanding of, I think, how ETFs work. And there does just seem to be a lot of really leveraged longs in Bitcoin. That tends to be the way. And I think we're not done stopping them out yet.
All right, understood. Yeah, a lot of inflows coming into the new funds, but more going out of GBTC. So first couple of days there was that net negative for flows. So all right, Peter, always love.
And I think we'll find out in the next week or two. I think it's going to take a couple months to figure out. The real key is, do RIAs convince their clients to put into Bitcoin? And it has to be those who have already, and that is a way to do it if they weren't comfortable. I don't think we'll know that until the summer, whether that picks up. So far, I don't get a sense it's going to, but that's what I'm watching for.
All right. Always love the ability to go from different groups and do a little dance across asset classes. For us, thank you very much, Peter Tchir. Great to catch up. And I like the specific trade ideas. Academy Securities.